Welcome to the studio, Sam. Please tell us a little bit about your company and your role there.
My name is Samuel Pelaez. I'm the lead analyst at Galileo Global Equity Advisors. We are a boutique investment manager in Toronto, focused on small and mid-cap companies across Canada. We have 2 mandates for growth and income, as well as institutional accounts.
The energy sector has been pretty beaten up over the past few years. What's your outlook for the remainder of 2016?
We are actually somewhat cautious for the remainder of 2016. We do expect energy prices to recover materially in 2017 as supply and demand come back into balance. For the remainder of the year, we would like to remain a little bit on the lower beta side of things. We do recommend a beta barbell strategy, so have a toehold in all your safe names and then a small allocation to the growthier names so that you can capture any growth that may happen over the next 6 months.
Natural gas was the top performing commodity in the second quarter of this year. Do you see this trend continuing?
Most definitely. I think there are 2 very particular fundamental drivers for natural gas prices. One of them has all to do with weather. We came of a mild winter, which weighed heavily on prices, but now we're getting into a very hot summer. We expect to see lower than average inventory builds, which will set us up nicely for the second half of the year. So prices should continue to rise. In addition to that, we believe that there's a significant change in the U.S. energy mix. For the first time ever, natural gas has surpassed coal as the major source of power generation in the U.S., and that fundamental driver should continue for the remainder of the year.
What are the most important factors investors should consider before buying an energy stock?
We recommend looking at cash flow returns on invested capital, and that's not only for energy stocks, but across the board. We believe it's one of the most significant factors that drives up performance across all sectors and essentially across all countries, because it's a factor that is very, very hard to alter. Management teams have to work very hard across a number of years to achieve very high rates of return on invested capital. In addition, it penalizes those companies and those management teams that go on spending sprees when the markets are near the peak. Essentially, they increase the capital required to deliver any sort of return. So we advocate for high return on invested capital companies across all sectors, especially those that are cyclical in nature like mining and energy.
What energy-related stocks do you like at this time and why?
There's one particular company that I'd like to highlight today. Its name is Renaissance Oil. This company is a junior E&P focused on developing the energy assets in Mexico that are becoming available as part of the deregulation that's taking place in the country. I don't know if you're aware, but after 78 years, Pemex is finally relinquishing its monopolio and allowing private companies to come into the market and foreign capital to participate in a very, very highly prospective natural resource market. The key thing I'd like to highlight about this company is its management. Chairman of the company and founder is Ian Telfer. He is the chairman of Goldcorp. Goldcorp is one of the largest foreign investors in Mexico, and it enjoys very good social license. This has allowed the company to make inroads into the whole process. Also, the management and technical teams all come from former senior E&Ps, especially Mitchell Energy. They were the developers of the Barnett Shale originally in Texas. So the level of technical knowledge at this team is that of a senior team that is just packaged in a junior team, and that's the opportunity right here. More importantly, the company just became a producer recently. They won 4 blocks that went for auction onshore in Mexico, and they now produce 1,700 barrels a day. Believe it or not, that makes them the second largest oil producer in Mexico, over a $40 million market cap. The company had a small initial investment of only $15 million, and with this production of 1,700 barrels a day, we can see that it will have a very significant growth in its return on invested capital. Lastly, I'd like to mention that there's significant growth opportunities for this company. They are now allowed to bid for the next round of auctions to gain more blocks, but also they're looking into JVing with Pemex directly thanks to the significant relationships this management team has built with the key partners in the country.
Do you have any other stock picks that you can tell our investor audience about?
There are 2 stocks I'd like to mention today. One of them is a REIT. The name is Pure Multifamily REIT LP. We particularly like this story because it's a Canadian listed residential REIT with assets in the U.S. It's focused specifically in Texas. Texas has one of the better demographic growth prospects of any state, and that has to do with tax incentives that have driven a number of Fortune 500 stocks to relocate to the state. Among those companies, we have FedEx, Toyota North America, State Street, among many others. This has resulted in a very significant growth for this company. They've posted like-for-like 6% growth in their revenues. In addition, their net operating margins have increased to now above 50%. Lastly, I'd like to point to the fact that this company pays us a dividend in excess of 6%. We like this dividend because it's been growing recently, but also because it's very sustainable. In an era of low rates like the one we're living in right now, these sustainable dividends are worth significantly more than they used to be. The last company I'd like to talk about today is Pacific Insight Electronics. We really like this company because of its high return on invested capital. The company manufactures and designs auto parts for the likes of Ford, General Motors, and many other large customers in the US and Asia. The company has one of the highest returns on invested capital across Canada, in excess of 40%. They managed to achieve this type of return by growing its revenues organically to the tune of 70% a year. EBITDA margins have also grown to the tune of 200% a year. In addition, the company has significant insider ownership in excess of 25%.
Thanks so much for taking the time for today's interview, Sam.
Thank you. It's a pleasure to be here.